Dividend investors, bonjour, Mike Hiru here, founder of Dividend Stocks Rock. I hope that you are doing well. I'm here to help you invest with more conviction so you can enjoy your retirement. And speaking of which, I've received a lot of questions about high yield dividend ETF. As you know, I always prefer to pick stocks over ETF, and today we're going to have that discussion, mostly because I realize a lot of my members at Dividend Stocks Rock hold ETF as a part of their portfolio or their core portfolio, and then they add some dividend growers to their portfolio to make a better investment strategy. It's pretty much like cooking when you have like your soup and your basic, well, your favorite vegetables and so on, and then you just add a few more spices to the mix. So this is what we're going to look at today. I've selected 3 ETF, actually with the help of my new tool here at Dividend Stocks Rock. We now track over 600 ETF, both on Canadian and US market, and this thing keeps growing, so it's accessible to the to all members, regular members and DSR Pro members as well. So we have the stock screener, we have the REIT screener, and now we do have a ETF screener that will help you look at total return over the past 1 year, 3 years, 5 years, the expense ratio, the historical spread, the discount or premium to the NAV, the region, the sector. So we have put a lot of information together. And since I've received a lot of questions about what do I think about those, those ETF, mostly covered call ETF done by BMO. So I would call them the ZW suite because they all start with ZW. So today we're going to look at the BMO Global High Dividend Covered Call ETF, ZWG. And then we're going to look at the Canadian High Dividend Covered Call ETF, ZWC. And finally, we're going to finish with the one that is probably the most popular, that kind of like put BMO's Covered Call ETF on the map, called ZWB, the BMO Covered Called Canadian Banks ETF. So let's get started. What I did is I went onto their website on the ETF, looked at the fact sheet to get myself getting started to do some analysis. I have 3 charts for each ETF, so let's move on to the first one. So ZWG, Global High Dividend Covered Call. This one has been created only 2 years ago, January in 2020. This is one thing that I look at because I want to know if I can see some history. In this case, not much. Management expense ratio is at 0.71, so you're roughly paying 1% to have this one managed for you. If you're looking for income, well, good for you because it has a monthly distribution. And obviously, you're going to look at the bottom of the graph, 6.96% yield. So we're talking about 7% yield spread across 51 securities and a beta of 0.74. So it means that it's going to do less fluctuation, a high income. If you look at the portfolio strategy, I love to look at that when I look at a ETF, just to understand a little bit more about what they want to do. So on this one, it's dividend focused, and they are obviously writing covered calls on those stocks. So it's not just the stock appreciation and the dividend yield, but you're going to get an extra income because you write covered call on it. Now let's dig in further to see how it has been invested so far. In terms of sector allocation, you can see it is an ETF that is a little bit geared more towards growth. We're talking about information technology, financial, and consumer discretionary. So whenever the market goes well, initially, this type of stocks, this type of investment should do well at the same time. Mostly invested in the United States, almost 70%. So you can think about a good comparison would be the SPY, so the S&P 500. But the S&P 500 doesn't write covered calls on those big guys. So you have companies that everybody knows, Microsoft, Home Depot, McDonald's, Verizon, Cisco, and so on. What is interesting is out of 51 companies, the top 10 is weight about 38%. So roughly 40% of your portfolio is invested in the top 10 holdings. So if you see any companies that you don't like here, maybe you want to skip this one and move to the next ETF. Looking at the returns, unfortunately, since it started about 2 years ago, we don't have much to compare, but you're going to see that the other two covered calls existed for a longer period of time, but we're going to have a similar pattern. Spoiler alert, the income you're getting means that you left a lot of money on the table in terms of total return. So when you look at the capital appreciation plus the dividend, it is usually better if you buy the index or if you go with a classic dividend grower ETF as this one that I've selected, VIG, Vanguard Dividend Appreciation ETF. Both ETF beat the BMO Global High Dividend Covered Call, even though they had big names like Microsoft and Home Depot that has done very well over the past 2 years. It wasn't enough. Actually, when you look at their returns, we're talking about 30% versus 13%, and that includes the very generous 7% yield. So basically, it's like buying a deluxe bond where stock price appreciation doesn't count that much and you only get more yield. Now moving on to a more Canadian-based ETF, still covered call, created in 2017. So we have roughly 5 years of history, about the same price, so 0.72%, so still around 1% in terms of management fees. Monthly distribution, so again, it works very well for income-seeking investors, especially if you're retired. You just want to have that paycheck every single month, while ZWC will do that for you. Smaller numbers of securities, only 35, so a little bit easier to replicate if you don't want to pay that 1% fee. And you get a distribution yield of 6% with a beta of 1.01. So it's going to be, it's going to fluctuate pretty much in line with the market, but it's going to generate a much higher yield. If you look at the strategy and the benefits, we focus on income, we write covered calls, and it's all about high dividend Canadian companies. So let's take a look at those. It looks a lot like the regular Canadian market, actually, with 38% in financial and 15% in energy sector. So not much difference here. If you look at the top 10 holdings, we're almost half of the value of your portfolio, so 47%. And one thing that really bugs me is that you have 1, 2, 3, 4 Canadian banks in your top 10. And on top of that, you have Manulife. But on top of that, you don't even have National Bank, which is the best performing bank in the past 5, 10, and 15 years. What a shame. What a shame. But it's not just there yet. If you look at that, you're just thinking, okay, so if I buy banks and telcos and then I bought a couple of pipelines, I'm pretty much having this ETF. The only thing that this ETF is adding up for me is the covered call that increased the yield. But in terms of building that portfolio, it is super easy. So now you're paying 0.72% for having someone writing covered calls on those stocks that are very easy to find by yourself. So let's take a look to see if it was worth it. 5 years, it's pretty good. We have a good uptrend until we got the pandemics, and then we got another uptrend after that. So not a full economic cycle, but enough data to see where the fund is going. And then again, you're leaving money on the table. Best pick was just pure index. If you go with the iShare Canadian Selected Dividend ETF, total return XDV.TO, we're at 53% over the past 5 years. And then you go down to plus 40% if you opt for the Covered Call ETF. So again, yes, you're getting a 6% yield. Yes, it is being paid monthly. But between you and me, the fact that you have something that is simple and shows a higher income costs you another 10% over the past 5 years, which is quite concerning in my opinion, because it makes a big difference, especially if you count on this type of products to fund your retirement. Now, I've kept the last one, the best one, for the end. But before that, please give me a thumbs up. Let me know in the comments below what you think about Covered Call ETF, if you have any in your portfolio. And don't forget to subscribe to the channel. Every Thursday morning I have a new video out. You're helping me a lot if you like and subscribe, because it spreads the word with all other investors, so I can then help more investors like you understanding the basics of dividend growth investing. Now back to ZWB, Canadian Bank Covered Call by BMO. This one was created more than 10 years ago, back in January 2011. Fees, monthly payment, all similar, but number of security, 7. I hope that they have Canadian Bank. I hope that they have National Bank on this one. The yield at 6%, the beta at 1, so pretty much in line. So the strategy is exactly the same as the Canadian ETF, Covered Call ETF. So we focus on Canadian stocks, we focus on writing covered calls, but this time the difference is we focus on doing that with Canadian banks. Sector allocation, no surprise here, 100% financial, all Canadian stocks. What is interesting though is while you have the top 6, so National Bank is there, woohoo, equally weighted, you also have the BMO Equal Weight Bank Index at 25% of the portfolio. Long story short, they pretty much use just banks to write covered calls. You know, as much as I do, if you invest in Canadian banks, they work in oligopoly. They use their strong position to make a lot of profit, and then they went through all kind of different markets, all kind of different strategies, such as expanding in the US, expanding internationally, using capital markets, or going with wealth management firms to expand their growth. But in the end, banks are solid, they're great dividend payers, and on top of that, they show strong total return. So is paying a fee to get covered call in a high 6 yield is enough for you, and is it worth it? Well, when you look at the past 10 years, it's not looking good. The covered call actually beat the TSX index, which kind of makes sense when you think about it, because Canadian banks pretty much beat all kind of market all the time over a long period of time because of what I just told you. Oligopoly, growth vector, stability, everything is there for them to succeed. What bugs me the most is I've looked at the total return of the best 6 banks, the largest 6 banks, and unless you're a big fan of Scotiabank, it is very difficult to not beat the covered call. So the average results for the 6 bank is 256% versus 163 for the covered call. So you're leaving almost 100% return over the past 11 years just for the sake of having 6% yield paid monthly. Do you really think it's worth it? I mean, I'm sorry, I don't think so. I think you're leaving too much money on the table. And if you like banks, let go of the covered call story and focus on the underlying asset. You're going to be a lot better. Overall, my conclusion over those 3 ETF, first, they're relatively easy to replicate in terms of holdings, and paying for a covered call strategy is not giving you more money. Actually, the thing is, whenever you're in a bull market, as we have seen over the past 10 years, covered call will underperform because at one point or another, the call option will be exercised and you will have to sell your assets. Well, actually, the bank, that BMO, will have to sell the assets and make less money than you would have if you had have just held the banks or the high dividend paying stocks in your portfolio and just wait for it for a very long time. As you can see, if you're looking at a high yield Canadian ETF, not much diversification. You're going to see the classic financial, telcos, and pipelines. And besides that, there's not much else you're going to find. So you can do that job by yourself. You can save that 1% in fee, well, 0.71, 0.72 to be honest, and still perform very well with your portfolio. So I hope that you have enjoyed this video. Let me know in the comments what you think about Covered Call ETF. And until the next one, don't forget to stay invested.